All right, I'm Michael Hartzman. Today is Tuesday, December 30th, 2025, and I'm on as always with my partner, Dominic Tavella. How are you this evening?
Doing great, Mike. I'm here down in our Florida office, so probably a little warmer than you, but maybe not by much.
Well, hopefully by much. That's why you buy real estate down in Florida, I've been told.
Well, I go where my clients go.
There you go. Wait, you go where your wife goes.
That's a conversation for another day. So,
Well, you and I took the last 2 weeks off, busy celebrating our respective birthdays, but we wanted to make sure we did our show tonight kind of as a year-end wrap up. So let me just jump into the numbers real quick. There's not a bad one in the bunch, I'm happy to report. So the big daddy, the S&P 500 was up 19 and change. The Dow Jones was up 16 and a half. The Nasdaq was up almost 23%. The MSCI EFA was up 32%. Emerging market MSCI was up 33%. The bond market, Dom, the bond market did bond market things very happily. U.S. aggregate bond market was up 7.3. U.S. corporates were up almost 8. Municipals finally had a good year, up almost 6%. And high yield was up 8.4%. And U.S. Treasuries, they ended the year around, on the 10-year, the end of the year around 4.73. So all in all, as you would say, in the beginning of the year, if I gave you these numbers, you would sign up for them immediately.
in a heartbeat, Mike, and put into context, and a subject we've kind of mentioned often. If you heard the experts in January, and you and I did, right? We make it a point to meet with every major Wall Street firm, every major bank and asset manager, to give us their thoughts about what is ahead for the year, what we could look forward to. And I would say at best the mood was solemn, low key, and certainly in numbers we've thrown out quite a few times. The expectation is that the possibility for a recession was quite high, anywhere between 40 and 60%. So we didn't come into this year with super high expectations, and fortuitously, it kind of all worked out.
Yeah, just for the record, you and I did not think we were going to have a recession this year, but there were some people who were a little more glum, and you're 100% right. And what was really interesting, Dom, as I wrote topics for the show tonight, I didn't once mention tariffs, and tariffs was something that was on the mind of everyone heading into the new year because President Trump campaigned on putting tariffs in. And that's exactly what he did in April. So I think it's really interesting that as I went through my checklist of things to discuss tonight, tariffs didn't even make the list. And a year ago at this time, we were all hyperventilating about how severe they might be and hoping they might not be so severe. And lo and behold, they were pretty harsh, and the economy did a very good job of being resilient and surviving that.
Well, Mike, I think you're exactly bringing up the right subject in that if we go back to January and the reaction by, again, the major Wall Street firms and even ours is like, hey, we have this huge unknown out there, right? We have this huge, we knew, I mean, if you didn't know tariffs were going to be coming down the pipe here, I mean, for God's sakes, the man got elected on that. I think all of us were anticipating some kind of a tariff event. It clearly caught the markets by surprise in terms of its intensity, the end of March, April. And boy, Mike, if you would have sold at that or panicked at that moment around April 8th, it's kind of in scar, my forehead here with that date. But the markets bottomed out, doom and gloom. And then, as you kind of alluded to, they weren't quite as harsh as maybe some people expected. And U.S. companies did an amazing job of adapting to the different environment. And not only did the market have a tremendous recovery from about a minus 20% to a plus 20%, just an amazing swing from the lowest lows to the highs. So tariffs end up being a big story in the short run, and kind of maybe a little bit less so today.
And look, and as part of what I want to talk about tonight is we've seen this movie before where the market gets clobbered and then quickly rebounds, right? We saw it during COVID. There's a number of examples of that. But also 2022, which was 3 years ago already, not so much. The market started to go down and continued to go down. So there's no certainty that when the market takes a big tumble, it rebounds immediately. But some statistics that we were talking about this morning on our morning call to me were really startling that I heard yesterday is that number one, the stock market hit 39 new highs this year. 39. So that's several a month. That's number one. Number two, the stock market has been up 8 months in a row. And number three, something that you and I look at and talk about is the volatility index, known as the VIX, is really hovering at not historic lows, but yearly lows. And what that basically means, Dom, and I'll phrase it in a form of a question. Do you think clients, investors are getting a little laissez-faire, getting a little taking this market for granted? Because when I see all-time highs, record highs, winning streaks of 8 months in a row, and a low VIX, the contrarian me starts to think something bad is brewing down the road.
Well, look, and if you look at it in the context of just since 2022, these last 3 years, they have double-digit returns in the
Yeah,
market every single year. Those of us that have done this for more than a week or two, that's not normal. And we saw a lot of press and experts talk about 97, 98, 99, and then we had the big tech bubble that finally, the markets fell apart in 2000. So there's some comparison now. Hey, do we have this AI bubble? Is it going to pop? Are we going to see just dramatic losses? We don't look at it in the same context as back then. And I'm sure we're going to get into that a little bit tonight. But in terms of clients getting used to, investors getting used to, hey, 20% returns, double digit returns are quite normal. No, they're not. And so we do have to be careful that we don't get kind of fall asleep at the wheel here and not be paying attention to what the weather report looks like for the next 30, 60, 90 days. We do have to pay attention. And we'll get into the economic data in a little bit, but I don't see a repeat of the late 90s, Mike. But investors are getting a little bit too used to this being kind of normal. And hopefully we don't pay the price for that.
yeah. I mean, to your point, I happen to have the number in front of me, and we didn't talk about this earlier, but it's a statistic that's on my chart. Over the last 3 years, the S&P 500 cumulatively is up 88%. The Nasdaq is up 130%, and the Dow is up 55%. Those are very robust numbers.
Yeah, really, really. And look, we talk about market weighting and how this large cap tech sector, particularly the Magnificent Seven or the Big Ten out of the S&P 500, you pull those 10 stocks out of your numbers, Mike, and those numbers look a lot more sane, reasonable. It's really been a large growth, artificial intelligence sucking up the entire S&P 500 in these performance numbers. We do not expect that to continue forever. But can the balance, the other 490 stocks, catch up? And I think the answer to that is yes. We've discussed it in the past, though I'm sure, again, we're going to discuss it a little bit tonight. but it might be time for this rotation where I think those big tech stocks continue to do well, but now perhaps the other 490 can take advantage of what's going on in the AI universe.
Yeah, and I think that has begun to happen because look, the Nasdaq always is outpacing the S&P 500, and this year, I mean, it outpaced it, but not by that much. I mean, the S&P through Friday was up 19.32, and the Nasdaq was up 22.96. So what is that, 2.5%?
Yeah, but Mike, and again, I remind everybody, if we look at the S&P 500, 40% of the value of the S&P is the same 10 stocks.
I
So
agree.
if these same 10 stocks go up, the S&P is going up. If these 10 stocks go down, the S&P is going down. The weighting of the other 490 stocks, unfortunately, it's not equal weighted, right? So I do look at that equal weighted S&P, and that's more in the 10 to 12% range year to date. And again, that's the effect of these massive large cap stocks dragging the rest of the index.
Yeah. So again, I'll just go over the numbers real quick. You're not wrong. Communication services was up 34. Technology was up 26. And the third best category was industrials. And that was up 21%. And then it drops off financial 17, utilities 16, healthcare 16, and so forth. And I think industrials was the third leading indicator. I think part of the AI story is the build up of these data centers. And I think, I was going to ask you about this later. I might as well ask you about it now. I think the whole data center story is going to be a main theme of 2026.
Yeah, so and I know, Mike, you get the question as well. Clients asking us, are we in an AI, artificial intelligence bubble? And what I'd like to tell clients is we're not in an artificial intelligence bubble. We might be in a artificial intelligence company bubble, meaning the specific companies that are tied into artificial intelligence, they're not all going to win. They're not all going to end the decade at the top of the heap. And historically, they don't. The companies that kind of are the beginning of these massive trends, think of the internet and the garbage.com era. We can go back in the 80s with other sectors, biotechnology in the sectors. The companies that start this thing usually are not the companies that end it and ended at the top of the heap. And in this case, a big component of artificial intelligence, you have to have the data centers to store and process these massive models, right? That artificial intelligence works off of. And there's already cracks in the armor, right? Oh, do we have enough? Are the right companies building them? Where are they getting the money, the financing to build them? Are they going to build all these data centers and they're going to stay empty because the world is not going to need them? And these are the important questions as we build out the infrastructure for AI. So big component of artificial intelligence is the need for energy and these data centers. And at least now, I think intelligently, Mike, asking the dumb questions. Hey, do we need them? Do we need this many? Are these the right ones? Are we building them in the right location? How do we power them? Big questions.
And to your point, and the reason I picked up my phone is I had to ask a younger person the name of this, but you say that the companies that we know now may not be the winners later. And my favorite two examples of that is Facebook. Facebook was not the first. MySpace was the first. And the name that flew out of my head was the first music streaming service was not Spotify, it was Napster. And I completely forgot about that. So I texted my daughter Amanda real quick, and she gave me the name. So you're right. The companies we think of today as cutting edge, they may not even exist 5 or 10 years from now.
Mike, you are spot on. Think about Amazon, which is just a gigantic company today. They came into the internet space selling books, for God's sakes. That was their thing. We look at a company like Google that just dominates the search world. Google didn't even exist in those days, Mike. So it's cutting edge technology, and it will evolve. I thoroughly believe it's going to change the world as we know it. But we got to be careful which companies we choose to be winners and losers, because it's highly unlikely you can just buy them, close your eyes, and it'll all work out.
And just getting back to the point about data centers, is the reason I think they're going to be talked about a lot in the new year is number one, this is how the AI play, if you will, or the AI investment spreads out, right? And the only way this AI boom actually happens, and we've been talking about it on this show for about a year and a half now, is we need to build out the energy infrastructure system, right? These giant buildings need to be cooled and they need to be electrified. They need to be powered. And that's what the data center story is all about. And that's why I think a part of the reason industrials was the third leading sector heading into 2026 is is the opportunity in that space, I think, is going to be talked about a lot in the next a number of years. The reason commodities are being talked about is we need a lot of those rare earth metals other than gold in order to create these supercomputers, nuclear energy. So I do agree with you. These opportunities, a lot of clients now are calling me about quantum. It makes me laugh. Reminds me of the old line from Seinfeld. You don't even know what quantum is, but but you want to invest in quantum. And I don't know about you, but I get that call all the time. That's the new buzzword.
You did make me smile, if not laugh, Mike. Because where are the phone calls for cryptocurrency?
Yeah,
Um,
remember that?
right? I mean, a year ago, I bet you we can go back and replay the tape here. All clients wanted to know was it Bitcoin or Ethereum or God knows, right? And look, we won't digress into crypto at this point in the conversation, other than to say it'll probably continue to be an important part of growth in the economy. But it's not the latest, greatest rage. Artificial intelligence is, and there's a lot to come down the pike here. State regulation, federal regulation, infrastructure, power lines. We can go on and on and on. Obviously, we're following it. Obviously, we're investors in it. Strong belief that you just can't buy, close your eyes and hold. It's just not going to work out in the end.
No, never does. So let's switch gears. Let's talk about a topic a little less sexy: interest rates and the new head of the Fed. So here, this is what we know, that the Fed lowered interest rates a couple of times this year, as we expected. Jerome Powell appears to have miraculously going to complete his term without getting sued or arrested or indicted or whatever else they try to do to get him out. And we're going to have a new Fed chief. Normally, that doesn't matter, but again, in this administration, it matters because the fear is, who will the Fed chief be? Will that Fed chief be independent? So, two-part question. One, what do you think is going to happen with interest rates in 2026? And two, will the new Fed chief, whoever it may be, will the market consider that person independent? And will the administration actually hire someone who they will allow to be independent? I know it's a loaded question. Have
Yeah,
fun.
I know. I'm looking forward to delving into those two questions, but I'm going to ask you one first, and then I'll come back to my answer. So the Fed just lowered interest rates 0.25%, correct?
Yep,
What did long-term interest rates do?
they popped up.
They popped up. Right. So here we have, I'm going to circle full back to the questions, Mike, where, hey, wait a minute. I thought the Fed lowering interest rates will affect market rates, i.e., what we pay on mortgages, what we pay on car loans, what And guess what, Mike? Interest rates actually went higher, not lower. We repeat this many times. The Fed controls the short end of the curve, the short maturity bonds. The markets decide what interest rates should be. So the 10-year Treasury today is higher than it was before they cut rates. Why? And to your questions, Mike, it's expectations for where is inflation going to go. It's expectations for where is the economy going to go. It's global interest rates. We don't live in this isolated igloo where only what we do here in the United States matters. It matters what interest rates do in Europe and Japan and the rest of the world. So I do think the Fed does continue cutting interest rates next year, but I think the overall effect on the economy is minimal. I don't see interest rates going dramatically lower than where we are right now, primarily because the economy is relatively speaking healthy and continues to grow, and the unemployment number has not gotten particularly horrific. And so I think the as long as inflation doesn't rear its ugly head, interest rates should stay roughly where they are today. In fact, if people are waiting for mortgage rates to go substantially lower, I wouldn't wait, Mike. There's a real possibility they could be slightly higher 6 months from now than where they are today.
So I agree with you. I think Chairman Powell and this Fed administration is done raising interest rates. I think his term is up in March or April, Tom.
I think March, Mike.
Yeah, me too. So I think this term, I think this Chairman Powell is done. But there is a real fear that the next Fed chair, whoever that person might be, might not feel as independent as a Fed chair is supposed to be. And let's just give that some context. People don't understand what we're talking about. The Federal Reserve is not supposed to be is an independent agency. So they're supposed to be apolitical. They're supposed to move interest rates in a way that fights inflation, fights recessions, and makes decisions in the best interest of the economy. Would you agree with that?
Yes. But we're all human.
Right.
And in that context, we could look at it historically. The idea that the Fed chairperson is going to be completely independent and not listen to any other voices outside of the Fed committee is a little bit I don't
Naive?
know, Mike. I don't believe it. I don't believe it happens. The Fed chairman meets with the head of the Treasury. The Treasury meets with head of Treasury meets with the president, the cabinet members, Congress. They testify. Everybody's got a voice. But you are correct. At the end of the day, they're supposed to do what is in the best interest of the country, and that is maximize employment and minimize inflation. So it's
Right.
dual mandate. They have two jobs here.
Right. And that's why they have 6 year terms. And again, just for clarification, although Powell has fallen out of favor with Trump, Trump hired him,
Yeah.
right?
Well, and great point, Mike. And this is something that we kind of lose sight of. When these people get these jobs, and the example I always use is people get elected to the Supreme Court, they don't always follow the script, right? At the end of the day, these people tend to be very educated, smart, high integrity people, and they take to their calling, they take to their responsibilities. So the fact that one of these individuals is going to get elected as chairperson and all of a sudden just throw all their lifelong history and education and morals and ethics out the window, I just find it hard to believe, Mike. I really do. I have a lot of respect for these people. I don't always agree with their opinion, but I think their motives are solid and their thinking is solid, even if it's not correct. History tells you if you're correct or not.
But I think that's going to be a major story for the first part of the year. Is depending on who is nominated for that position, his his appearance is going to be a man. There's only four candidates left, they're all men. That he will be independent, and I'm not naive. It's not as if they're not going to take a call from the president of the United States. They're going to, and they have to. But at the end of the day, the president may give his opinion, but the president doesn't get a vote.
And Mike, look, you and I have been in this industry for 40 plus years. We're not far removed from the days of the bond vigilantes. For people who don't know what that is, it's the early 80s where the bond market decided, hey, we don't care what you're doing at the Fed. We think inflation's out of control, and interest rates spiked up through the roof. And eventually, the Fed chair at that time brought inflation back down by actually raising interest rates. But the bond market determined where the correct place was for interest rates. And that's the danger here, in that if the person that President Trump nominates kind of seen as not independent slash not doing the right thing, interest rates will actually spike. So the idea that we're going to lower interest rates could have the actual opposite effect. We could be looking at much, much higher interest rates, especially again if inflation rears its ugly head.
And to your point about the bond vigilantes, and just for the historians out there, the Fed chief at the time that you're talking about was Paul Volcker.
Correct.
And then I give the bond vigilantes all the credit in the world for what happened back in April, where you pointed out the market, really tanked. It was the bond vigilantes, Dom, and other countries selling the dollar off, where the Treasury Secretary went to Trump over the weekend at his home in Palm Beach and said, "You have to back off." Right? So the bond vigilantes not only have a loud voice, they get listened to.
Yeah, the markets ultimately react, right? We saw that very violent pullback in the markets again, the end of March, beginning of April, 20% on the major indices, because the fear factor was that the tariffs were going to create hyperinflation, right?
Right.
That we were going to have dramatic rise in costs because of the tariffs. And as a result, inflation was going to go crazy, and that means interest rates spiked through the roof. Again, all that settled down, and we ended the year. We will end the year hopefully in a very, very good place. But the markets do speak a language that the politicians ultimately have to listen to.
Yeah, they do. Where basically, if you don't behave in a way which we think is appropriate at this time, you will pay the price at the voting booth. Let's take a break on that, and then when we come back, we'll talk a little bit more about what we expect in 2026. So Dom and I will be right back after a quick break. All right, I'm Michael Hartzman, back with my partner Dominic Tavel. It's just the two of us tonight doing a 2025 recap and a 2026, hopefully, look ahead. So, Dom, one of the other factors heading into 2026, whether you call them tax cuts or tax refunds, the IRS expects an enormous amount of money to flow back into the economy at tax time. So why don't you spend a few minutes going over what that means and how did we get here?
Yeah, so when we're doing this, Mike, we obviously try to gauge out the pluses and the minuses. And one of the big pluses is an estimated $100 billion plus. And I've seen bigger numbers than that, Mike, expected to come back into the economy in the form of refunds. And that's by April 15th, right? So that's a first quarter event where we can see an extremely large amount of dollars come back to taxpayers. So let's start with number one, they passed the new tax law, but they did it last minute, right? In here in 2025. The IRS never adjusted the withholding tables for payroll purposes. So the ADPs of the world, the paychecks, these computerized payroll systems never updated for the new lower tax brackets. So there was an over withholding. It took too much money out of your paycheck. They're going to have to give it back. Throw in, we have a higher standard deduction than we did the prior year. We have now a higher soul tax. Those are the state and local taxes. It was capped out at $10,000. Now it's up to 40,000. We have that senior deduction. If you're over 65, and these are all subject to adjusted gross income limit, so it's not for the rich. It's that middle class people. But an extra $6,000 deduction for seniors over 65, married couple, that's at 12,000 of income that they don't have to pay taxes on at the federal level anyway. And then we can get into no tax on tips and no tax on overtime, and that's limited, but again, puts extra dollars into people's pocket. The number could be huge, and I think will be a economic move the needle event, Mike. That's a lot of money to come into the economy, and you know our clients and consumers, they have those extra dollars in their pocket. They're going to spend them. So we think that that's a big stimulus to the economy in the first quarter.
Yeah, they'll spend it. I mean, it's funny. Two numbers came out last week, which I should have mentioned earlier, but it's a good time to mention it now. It kind of shows a bit of a almost like a bipolar mindset right now because Dominic, the U.S. economy grew last quarter, third quarter of 2025, at a clip of 4.3%, which is way higher than anyone anticipated. But the flip side of that, Dom, is consumer confidence dropped from 92.9 to 89.1. I know the government would love to keep the consumer confidence number above 90. So, I think our clients would be thrilled to hear what you just said, but it does appear at the moment that a lot of our clients, a lot of people in general, are kind of living in these bifurcated universes.
Mike, I don't want to oversimplify this, but prices have not come down.
Exactly.
So, I'm going to go back to the prior administration, and let's say you go to the supermarket and you were spending $100, right? Well, now you go to the supermarket and you're spending $125, and your expectation was most voters' expectation was that Trump would come in and prices would go from the 125 back down to 100. Well, they've gone up. Even if it's 2, 3%, they've gone up. And so I think there's a sort of a disappointment. Maybe that's not fair, Mike. In order for prices to go down like that, we'd have to have a recession. We'd have to have unemployment at 10%. The economy, as you just said, is growing. The employment numbers are relatively flat, which I guess is positive. We're not seeing unemployment go through the roof. But people were certainly expecting that overall prices would fall down. And we've seen some energy, gas particularly, but generally speaking, you go out to that steak dinner, it's still costing you an arm and a leg.
Look, and I think part of the problem is is that the general public does not really know what inflation means. And I think the media knows what inflation means, but they'd like to distort what inflation means. So when inflation goes down, it does not mean prices go down. It means prices are going up less quickly.
Mike, you're spot on. Inflation. So even if it's a 1%, it still means it's growing, right? Deflation is when prices actually go down. And I'm not saying it can't happen, but if it happened across the board, it would have to mean some kind of economic event. Think of COVID in 2020, Mike, when basically the economy froze, right? People were all stuck in our home. Nobody was going out to dinner. Yeah, prices dropped dramatically because there was no money circulating in the economy. So we want to see inflation level out somewhere around this 2% number. And maybe companies incorporating artificial intelligence makes them more efficient in their business model, and prices will not go up dramatically. And God forbid, maybe go down a little bit. So we'll see what happens. But inflation, and people are not happy about it, Mike. They're still paying way too high for just about everything.
Yeah, look it, under the category of be careful what you wish for, we do not want a deflationary economy.
No, and the easy one to talk about is energy prices, and whether you agree with it or not, the idea that we are deregulating energy, we are building infrastructure in this country for energy. Cost of a barrel of oil, cost of natural gas has dropped pretty dramatically. We have a glut of it around the world. That helps economic activity, and it keeps costs from going higher, right? Even if some costs go higher on this side of the ledger, hey, we got costs lower on that, we can flatten out the overall effect to the consumer. And I think that's pretty much what happened this year, Mike. A little
Yeah, and to your point about
the
inflation, and
tariffs, lower energy prices, they kind of melded in the middle.
sorry about that. And to your point about inflation, you know, the Republicans a year ago did a phenomenal job, in my opinion, in messaging that the economy's a mess. And you and I would say the economy's not a mess, right? But voters were convinced the economy is a mess, and there's a portion of the economy in the population that unfortunately is always struggling, and it's always a mess for them, and that's that wealth effect and that wealth gap, right? But I believe it wasn't immigration, it wasn't the Supreme Court. What really won Trump back the White House was the Republicans did a phenomenal job in telling us, the voters, the economy is a disaster. And now the shoe's on the other foot. The Democrats are doing exactly the same thing. It's basically the same economy. We do have lower interest rates. You could argue it's a better economy, but the Democrats have done a very good job of messaging the economy's a mess. Trump calls it a hoax. So let's talk about the midterms, because I think Trump's got 6 months to change the messaging, or they're going to get clobbered come next November.
Yeah, so the easy one on this one, Mike, is again historically the party in charge loses at least one or both sides of Congress, right? So statistically, there's a pretty good probability they're going to lose one or the other. And I think likely, Mike, whether obviously there's a lot of people that like this particular president, like his style, but there's a lot of people that don't. And maybe there's going to be a little bit of disappointment. There's might be a little bit of, and this happens across all administrations, by the way. So again, we're not just picking on
Of
President
course.
Trump or the Republicans, but historically, the ruling party loses one or both sides of Congress. So that expectation is probably real. And then we'll have to deal with it from the economy, markets. You would think that cooperation would take over now, that the one party or the other couldn't make decisions completely on their own. That usually when you have both parties in the mix, you get better outcomes. but that means they have to talk to each other, Mike, and cooperate and think about what's in the best interest of the country. And my gut feeling is all they're going to think about is the next presidential election 2 years later. But hey, there's wishful thinking, right? That
Yeah,
cooperate and work with each other for the better interest of this country.
go figure. What a concept.
What a concept.
You should run for office. Hey, let's go back to the economy one more time, and let's talk about the wealth effect that the stock market has had on consumers. Because as I said earlier, there's a third of the economy that really does struggle, and it's unfortunate. And when we talk about the wealth gap, it's real because there are more 401k millionaires today than there ever have been. I know you and I, in our practices, have more $1 million households than we've ever had before. And my favorite example is I was at a client's house last week. She was running late. I was sitting there with her son, and she had just come back from Price Club. And she was complaining how expensive things were. And she has a very nice account with me. She has a pension. She's a very nice lady. I said, "Did you buy everything you wanted?" She said, "Of course I did. It just costs more." And thank God for her, right? And thank God she's able to do that. But I think for a good portion of the economy or the population, Dom, that's what we're experiencing. They don't like paying more, but they are paying more because they've never had more money in their accounts. Between 5% interest rates on CDs and treasuries for a couple of years, and the stock market doing what it's done for the last 3 years, there's a good portion of the economy who just bites their lip and pays the higher prices. And in my opinion, that's the wealth effect of the stock market, which insulates them, and that other part of the economy just cannot and will never benefit from that.
It can't, Mike, and it's extremely sad. We again, a topic we've addressed many times, but there's roughly half the population in this country is struggling, literally paycheck to paycheck or social security check to social security check. So when they go in that supermarket and they're spending, instead of $100, they're spending $120. Those are real dollars that they're struggling to allocate where I should put it and what I can't afford to buy today, including medications, right, and prescriptions.
Mm-hmm.
But the other half of the country, and particularly the top third of the country, if you've had a 401k these last 3 years, you've done really well. You've improved your net worth. If you look at housing prices over the last 5 to 10 years, your wealth has gone up pretty dramatically. And God forbid you actually had some savings. The interest that you're earning on that savings has been pretty wonderful stuff. So, from a wealth perspective, a net worth perspective, most Americans, especially the top third, are doing quite well. It's that bottom third, bottom half that you worry about, Mike. They don't have the resources, they don't have the paycheck to meet these higher costs. So, again, this is what politicians should be focusing on and figuring out how to help these people. And the rest of it will take care of itself. But the idea that you have real assets, retirement, bank savings, investments, real estate, that means your net worth, the value of everything you own, has gone higher over the last, especially the last 3 years.
And hopefully, what you said earlier, the tax benefits of the bill that was passed earlier this year, and the over withholding that happened inadvertently, that will give those folks a boost come April, and probably an unexpected one, because I think a lot of people again really don't pay attention to that and might be pleasantly surprised when they do go to their tax preparer in the next couple of weeks.
Yeah, Mike, look, we all got our paycheck, right, on Friday. So everybody knows what that number is, right? And so you didn't see a change in that number. Yeah, you heard something about a tax break for rich people being passed, but nobody looked at their paycheck and understood that there was actually a different calculation that was supposed to have been done. And all these other add-ons, the higher standard deduction, the salt tax. Mike, you and I being New York residents, we know how high real estate taxes are and state income taxes are. And the old days we could write those off. Now you couldn't. Well, they gave us back, at least some of us anyway, $40,000 deduction in those type of expenses. So there's a lot of things in this new tax legislation that really targets the middle class. But if again, if you're at the lower end, I dare say lower than the poverty line, you don't have a job, you don't have withholding being taken out. You can't take advantage of these deductions. You can't take advantage of some of the new tax laws that have taken effect for 2025. So again, there are other things the government's doing for those people, but I think the struggle still continues for them, unfortunately, Mike.
All right. We talked about interest rates. We talked about the new Fed chief. We talked about AI and the opportunities there. We talked about the midterms, the economy, the wealth effect, tax cuts. So now it's crystal ball time. A couple days away from 2026. What's your forecast for 2026? And what's going on with the models? How are we preparing for 2026?
So let's start with, and you touched on a lot of what we look at, right? And again, I bring this up all the time. It's the weather report. Look at the weather, see what's going to happen, right? So we look at what do we think interest rates are going to do? What do we think inflation is going to do? And we've talked about it. Interest rates should stay relatively flat. We don't think inflation dramatically rears its ugly head. In fact, it could trend downward modestly, but trend downward. The economy, you brought up the number, Mike, grew at over 4%. Now, those numbers do get revised, and maybe it's only 3.9. Who cares? That's an outstanding number. Unemployment seems to kind of flatline, so no big job growth, but no big layoffs. We don't see that happening as well. Lower energy prices. So we have a lot of the built-in economic cycle to go. Should be a relatively speaking good year for the economy, relatively speaking good year for the markets. Earnings are supposed to grow somewhere between 8 and 10%. Again, we're not predicting a recession. No one is at this point, Mike. So all things being equal, should be a modestly good year. What I worry about all the time, Mike, is the meteor that comes out of the sky. What don't I know? What don't I see? You brought up midterms, Mike. Depending what happens with the midterms, that's in November. You could have a pretty ugly last couple of months of the year, right, Mike? You would agree with that?
Yeah,
Depending.
100%. Now, look, I don't think it starts in November. I think that toothpaste is out of the tube by September, by August, right? I mean, the pollsters get it right pretty frequently. We'll know which way this thing is headed by the end of the summer.
Yeah, and look at that. They're already saying at least one side or the other, right? Mike could turn. And if just sort of why do we bring that up? Because will they cooperate? Will they work together? Will they work as a team for the benefit of the country? Or will the next 2 years be nothing but bickering and nothing gets done? And that obviously affects the economy. How about what if the Fed, what the Supreme Court might do with tariffs, Mike? What do you think this, how do you think the Supreme Court rules on Trump tariffs? Are they legal or not?
So the line I've heard more than once from people way smarter than me is the Supreme Court will thread the needle in curbing presidential power, but not reverting the tariffs. Again, I hear this from people way smarter than me at the meetings you and I go to, Dominic, and I think that makes a lot of sense to me. I don't think I don't think the Supreme Court makes us reimburse all these
Yeah,
countries in the
an
dollar.
estimated 2 to 300 billion dollars that would have to be returned. And by the way, that these tax cuts that we just talked about, how do you think they paid for them, right, Mike? So the idea that the government would have to borrow 2 to 300 billion dollars, again, that affects interest rates. Higher interest rates slows the economy. There could be some extreme volatility. So Supreme Court decision worries me. The market short term, I think, could be very violent reaction to that. We talked about the election in November. That worries me. Geopolitical events. We've watched. Who would have guessed, Mike? Would you have guessed? war in the Middle East, Israel attacking Iran, and the whole thing is over in what, 11 days, was it?
Was it even 11 days? It seemed like 11
Uh,
hours.
yeah, I don't want to stick my foot in my mouth, but
Yeah.
let's just agree that it was an insanely short period. Yeah,
Oh,
but
by the way, don't forget the bomb we dropped on Iran.
oh yeah, just didn't let them play in the playground over there. We participated in the most hands-on way possible. We dropped the biggest non-nuclear bombs ever created in the history of the world on their nuclear sites. We have a president that's attacking boats off the coast of Venezuela. What happens there, Mike? What happens? I don't want to use the word invasion, but what happens with our involvement in Venezuela, in South America in general? There's. I always worry about what I don't know, Mike. It's the
And
meteor out of the sky.
that's my point. I started the show with why is the volatility index, why is the VIX so low? Why are investors so complacent? Right? And we've gone full circle.
Yeah, literally full circle. And we know investors' markets get a little complacent, and that's usually, in my opinion, when you squirrel some money away. Maybe you take some risk out of the portfolios, you park it off to the side. Um, and then, I don't want to say inevitable, but it's pretty inevitable, right? How many times have we said like 10% corrections are normal? You normally get at least one every year. 5% is just a drop in a hat.
5% could be a Tuesday.
Yeah, it's just, you know, um, but our job is to keep looking at that weather report, and if we see storm clouds, be proactive. I do want to say because of this tax cut, I think we're going to be, relatively speaking, should be a decent first quarter. Historically, markets do perform well through April 15th for a multitude of reasons. Um, all things being equal, again, the Supreme Court decision when it comes down being perhaps the big unknown, we should go into 2026 in good shape and have a relatively speaking decent first quarter.
Yeah, and I agree with you. The economy, we've been saying it for a while deteriorating, is not falling apart, not falling off a cliff. The job market, while deteriorating, is staying very, very strong. I continue to have virtually no clients express any job insecurity whatsoever. Again, I know sometimes they're rolling, job deterioration here where we are on the East Coast seems to be a pretty solid job market.
And Mike, we get that quarterly report. Small business is not really hiring, but they're not really firing, right?
Exactly.
And again, I think, and we're small businesses ourselves, right? We're just all dealing with the unknown, and we're not going to lay somebody off unless it really, proverbially didn't have a choice. And I think most of American businesses are like that. They value their employees, they respect them and their families, and they're going to hold on to them as long as possible.
And our models, we have 2 minutes to go. So at our models, as always, we're remaining proactive and actively trying to take care of the opportunities. And as you like to say, avoid the landmines to the best of our ability.
Yeah, we've been taking these last couple of weeks to set ourselves up for January 1st. We do have a little bit of reserves just in case. We always like to keep a little cushion just in case. But again, we're cautiously optimistic for the first quarter. So we've kind of laid the portfolios out, hoping to capture as much of that as possible. So again, think we're in good shape, but very, very much staying attuned to what the market conditions are doing, and hopefully they continue positive.
So, look, on that note, let me wish you and your family and all of our clients a happy and healthy new year. And we appreciate each and every one of you for tuning in and listening to the podcast. If we didn't know for a fact that you were listening, we wouldn't do it. We don't have to hear the sound of our own voices. So I want to thank everyone for continuing to tune in and continuing to thank us for doing our show when we do.
Yeah, Mike, and I know you and I both feel this way, and we express it quite often. The gratitude, the size of the firm of Lebenthal today is at an all-time high. both myself and Mike, I'll speak for you. We feel genuinely blessed that we get to do this for a living, get to take care of people, and we have earned your trust and hopefully get to keep your trust. So thank you for that, and very, very happy and safe New Year.
Happy New Year, everyone. We'll see you next year in 2026. Have a good night.
Happy New Year.